Ladies and gentlemen, good morning, and thank you for joining our analyst and investors call on our Q3 results. As you have read in our financial reports at Montea, all lights are on green for 2024. We are ahead on our ambitious growth plan, Track 27. The gross lettable area of our portfolio is for the first time above 2 million square meters. We will achieve our earnings per share for 2024, and as always, our operations are built on solid financials. Last but not least, all Montagners are very proud to have been nominated for the prestigious Belgian Entrepreneur of the Year award, a recognition for our strong track record over the past years. We will host a Q&A session after the presentation, but I would like to ask Els to start this presentation with the highlights of our first quarter.
Thank you, Jo. So, the EPRA earnings from recurring activities for the first 9 months of 2024 increased by 16% year-on-year to 71.9 million euros. The recurring EPS increased by 4% year-on-year to 3.35 euros per share, despite an increase by 12% in the weighted average number of outstanding shares. The net result, which includes the EPRA result, as well as a positive portfolio revaluation of 55.7 million, stands at 121.7 million or 5.98 euros per share. Furthermore, we add 0.18 euros per share to the EPS as a result of a positive one-off of 3.7 million, thanks to the Dutch FBI status that was granted to Montea in Q3 for fiscal year 2023. This results in a total EPS for the first 9 months of 2024 of 3.53 euros per share. This also implies that our targeted DPS for fiscal year 2024 is up from 3.60 euros to 3.74 euro per share. Total property result increased by 4% to 89.7 million euros, driven by a positive like-for-like rental growth of 3.4%, which consists out of 3% linked to rent indexation and 0.4% linked to rent renegotiation. In the total property result is also included 5.8 million income from solar panels. The total income from solar panels declined by 1.2 million or 17% as a result of a reversal of a provision for green certificates that had a positive one-off impact in Q3 last year for 1.3 million. Operating results stands at 79 million, leading to an operating margin of 88.1%. Financial result improved by 38% as a result of an increase in capitalized interests due to the transfer of Tiel and Born from yielding land bank to the development pipeline. The tax line is positive as a result of the inclusion of the FBI-related one-off of 3.7 million for fiscal year 23 that was taken in P&L in 2024. This all leads to an EPRA result of 71.9 million, based on a weighted average number of shares outstanding of 20.3 million. This leads to a recurring EPS of 3.35 euros per share, a one-off EPS of 0.18 euros per share, totaling a total EPS of 3.53 euros per share. Looking at the financial KPIs that are very solid, we have an EPRA LTV of 36.7%. The adjusted net debt on EBITDA stands at 7.7 times, so well below the target of around 8 times. The interest cover is well above target as well, 4.5 times, and the EPRA NTA rose by 7% year-on-year to 77.1 euro per share. Looking at the funding or the liability side, we see a strong and well-diversified debt profile with long-term funding, both on the debt and hedging. So the average remaining maturity for debt and hedging is both above 6 years. The hedge ratio stood at 98% at the end of the third quarter. We have a very strong liquidity position of 246 million euros, which is cash and untapped credit lines that are immediately available for use and which don't include the capital increase that we successfully completed earlier this month, for 154 million euros. Cost of debt is stable and well below the target of 2.5% and stands at 2.3% for the first 9 months of 2024. So back to you, Jo, for the growth plan.
Thank you, Els. As you know, we announced earlier in October our new Track 27 growth program, where we have the ambition to increase the portfolio from 2.3 million to 3.5 billion by the end of 2027, which is an increase of 50% in total. And we are a bit ahead of this plan since already 35% for the 439 million is already either invested or in execution. So we have an ambition to invest this year 400 million, 300 million next year, and then 26 and 27 another 250 million in order to get to that portfolio of 3.5 billion by the end of 27. We completed 2 really beautiful projects over the last months. One was in Vorst in Belgium, in Brussels, which was the redevelopment of the former Unilever site, Lipton tea bag factory, that we transformed into an e-commerce delivery center of 21,000 square meters for Deleuze. It was an investment of roughly 38 million, and we have a 15-year fixed lease on that property with Deleuze. And then another very nice development we did in Waddinxveen in Holland, a 50,000 GLA distribution warehouse with cooling and freezing for Lekkerland. It's also a 15-year lease and an investment of 45 million. And then we bought a building in Maastricht. We see it as a redevelopment. We now have a tenant in it for the next 10 years, but after that we will redevelop it a bit like we did in the past, for example, in Germany, in Mannheim and Leverkusen. And on average on these 3 deals, we do an average yield of 6.6%. This is a bit below the 7% that we promised you. The reason is that Vorst was a deal we already did, I would say, pre-financial crisis or pre-interest rate crisis. And that's why the yield on that project was at the time 6%. So that's why the average is a bit lower here, since you know that we target on average on our development projects yield of 7% yield on cost. Of course, after the closure of the third quarter in October, we did this beautiful reverso deal. We already bought 17 of the 18 assets. There are just some last CPs on the 18th one. But we already bought 17 of them half October. It's a total land bank of 650,000 square meters because there's only 80,000 square meters built on those plots. It's 100% occupied by Jackie Perrenot for a duration of 9 years. So basically what we did is we say, okay, we have those buildings and we take for every square meter of building, we take 3 square meters of land. And then we deducted that from the 650,000. So roughly we added 400,000 square meters to our yielding land bank. You know what it is. It's land that we own, where we get an income from, and where we know one day there will be redevelopment potential. Of course, we want to continue our pipeline in Belgium and in Holland. You see those different projects. Some of them are under construction, for example, Tongeren and Bluegate, Aalst also. Then we have buildings where we have the permit, but not yet the tenant. That's the case for Halle, that's the case for Grimbergen, and that's the case for Lummen. And then we have buildings where we have the tenant, but not yet a permit, and that is the case for Zellik. In Holland, we took off Waddingsveen because it's now delivered. Tiel, we can still build after we developed the first building for Intergamma. We can still develop 160,000 square meters. And so there we have the permit, but not yet a tenant. Same for Born, permit in place, but not yet a tenant. And Amsterdam, that is under construction and will be delivered in due course. All this leads to a development pipeline where on this page you see everything that is either delivered or in execution. In total, there is more than 200,000 square meters that is already either delivered or in execution. And we already have development gains on this portfolio of 51 million euros. I have to repeat it over and over again. It's 100% pre-let, our pipeline. Everything that is in execution is 100% pre-let. And the average duration of these leases is 13 years at first break. Then, of course, we have all these beautiful projects where we have today the permits in place, but not yet a tenant. That's in total 280,000 square meters. And then we have those where we already have the tenant, but are waiting for the permit for another 40,000 square meters. I repeat that the average yield on cost we want to achieve is 7%. And after we have realized all these projects, we will still have a land bank of 1.8 million square meters. As I said, we added roughly 400,000 square meters of the Reverso portfolio to our yielding land bank. And then Maastricht, of course, because it's a redevelopment project. So the land bank now stands at 2.7 million square meters, of which 45% is yielding at an average yield of 6.1%. The grey and brownfield part of this land bank is now more than 80%. This brings me to the portfolio KPIs. We have today a positive portfolio revaluation of 59 million. Remember, I just told you that we already had 51 million on our development. So it's basically 51 million on our developments on our land bank and 8 million from a portfolio revaluation. The portfolio now, including Reverso, stands at 2.7 billion, so well on track towards the 3.5 billion for 27. And our net initial yield remains stable at 5.1%. This is something you know. Here you see the development gains, the development margins we've been able to achieve. Again, if you take the last three, Q1, Q2, Q3 together, you have the 51 million development margins. If we look at the portfolio, we see that in Q3, another 1% increase in ERV and 1 base point yield increase. So you see on the right-hand side that those two that were far away from each other, I would say in 23, the yield and the ERV were in a compensating each other. Now over the last 3 trimesters, they're coming together and they're still balancing each other out, but on a much lower level than what we have known in the past. All this leads to a positive portfolio revaluation of 0.5% for Q3. So that is the 8 million next to the 51 million of development gains. Also, our reversion is bottoming out. If you look at the last 3 trimesters, we are roughly around 10%. That means that ERVs are back in an increase in the same way as our indexation. So that's why this 10% reversion potential is bottoming out. And maybe very important slide. It's something where we went over quite fast in the past because obviously everything was pre-let. I've read in some reports that there are more doubts about the reletting, and that's why I want to elaborate a bit on this slide. For 2025, as for 2024, we have roughly 9% of our leases that come on expiry. If you look at 24, we were able to extend or relet already 92% of those break dates. We were even able, for those where we had the option to renegotiate, to increase the rent by 14%. And we see the same 9% for 2025. So 9% of our leases will come on expiry date. 40%, 40% of that 9% is already extended. And if we go through it line by line, we think that roughly 15 to 20% of those 9% might have the intention to leave. If we look at a 5-year average, we had an extension or an extension rate of 85%. Even due to the slowdown, we put this now at 80%. So we see 20%, 20% of 9%, that means 1.8% in total. So roughly, if they would all leave and we would not be able to relet anything, then we would still be at an occupancy rate of 98.1%. So we are very confident on 2025, but I think given the uncertainty in the market that it was important to elaborate on that figure. More on the market, Ina, I would like to hand over the clicker to you.
Thank you very much, Jo. So with economic outlook being what it is, which is uncertain, we clearly see that this is reflected in the decision-making process of occupiers. The occupier sentiment, however, is showing signs of improvements, and this is evidenced from the latest census study completed by Savills and Tritax Eurobox last month, where 53% of those surveyed indicate improving business conditions, and that's compared to 34% the year before. In general, we see similar trends in our portfolio that occupiers remain more cautious than investors and developers, and this is in line with the investment market activity that we observe on the market versus the take-up. Nevertheless, the sentiment is improving, and even for the segment of 3PLs who have been most cautious in the past, they're also improving in reporting improved market sentiments. If we look at warehouse space demand, one thing that is very clear and positive is that the right sizing after the pandemic appears to be complete. So any space changes that were required as a result of pandemic with the increase in utilization and the consecutive reduction appears to be complete. And more occupiers are indicating that 1 to 3 years down the line, they're ready to grow again and they will need more space than last year. We believe that coupled with slowing development pipelines, particularly when it comes to speculative developments, and in Montea's markets being at an average vacancy rate of 3 to 4%, we believe that this uptick in demand should result in improving market fundamentals over the months to come. Tenants increasingly turn their focus towards very well-positioned locations, and this is something that we continue to see as a result of increased transport and labor costs, that this is becoming more and more in focus. So in short, the core locations are going to be in even more focus and demand, and this is what we would expect to continue happening. We at Montea are well positioned to capture this occupier demand, especially when we look at the census on where the occupiers are expected to take up the space. The main demands come in Germany, France, and Belgium, as well as the Netherlands. And these are the markets where we foresee a lot of growth, and these are also the markets where we are active. We also look looking at the space demands for new warehouses. It's clear that 54% of occupiers indicate demand for big box units, and this is where our pipeline comes comfortably into play, and we are ready to address and take on those needs of future demand. Els, over to you for the outlook.
Thank you, Ina. So the EPS guidance is uplifted for 2024 from 4.50 euros per share to 4.73 euros per share, including the FBI status that was granted for fiscal year 2023. Of course, this also has an impact on the DPS guidance for 2024, which is uplifted from 3.60 euros to 3.74 euros per share. Recurrent dividend increases by 6.5% year on year. And we reconfirm our EPS guidance for 25 to 4.90 euros and for 2027 EPS guidance of 5.60 euros per share. If we look back at a period or a 10-year period, then we see that EPS grew on average by 8% per year. And looking forward, we guide for a 6% EPS growth per year on average, going to 5.60 euro in 2027. That brings us to the last topic, ESG. Back to you, Jo.
Thank you very much, Els. Just very briefly on ESG, I wanted to elaborate a bit on the GRESB score improvement for our existing portfolio, and I wanted to go into detail on that because basically this is something we always see the total score, but I wanted to give the detail to well understand why we are where we are. You see that we started in 21 at a score of 69, and we were able to increase it year by year to 79. This is a score that compares you to your peers, which means that if you win a point, somebody else has to lose a point. It's a bit like the elections. So basically, if you go up, somebody else has to come down. We are now at 79%. But what is very interesting to see is that basically, when you look at those elements in that scorecard that we find important for our sector, which is the reduction of greenhouse gases and energy efficiency, we are doing very well. Where are we underperforming is basically on building certification. And why is this? This is because certification is an expensive exercise. And we think that since we are a developer and an investor, we don't sell our buildings to the market, we keep them in our portfolio. It would be a waste to certify the entire portfolio. So although all our projects are BREEAM alike, we don't have the certification, and that's why we underperform compared to the market. So it would be very easy for us next year to increase our score. We would just have to do the certification and everything would be great. Still, today it's our policy not to do it because it would be, we rather spend that money on our buildings than just to have a kind of diploma. If we look at our projects, we're even doing better. There we see that we get an 88 score. So amongst, I would say, 15% best buildings that are delivered in the market. And again, you see that we are close to 100% on many of the criteria. 9 out of the 12 criteria, we score above 90%. So we are within the 10% best in class in the market. And again, the building certification is the one where we are underperforming for the same reason. We don't sell our buildings, we keep them in the portfolio. I thought it was important to give you that detail on the GRESB scoring. We continue our program to invest in solar panels. This year we do an additional capacity of 10 megawatt. So we will be at 88 megawatts by the end of this year. And as already announced in Track 27, our ambition is to go to 135 megawatts by the end of 27. Same goes for battery storage, where we tend to invest 50 million euros by the end of 2027, which will result in a battery storage capacity of 100 megawatts in Belgium and in Holland. This brings me, ladies and gentlemen, to the end of our presentation. Thank you. Thank you very much, Ina. Thank you, Els, for your support. Thank you all for being part of this Q3 update report. Thank you all for joining, and have a great lunch. Thanks. Bye-bye.
Bye-bye.
Thank you.